In this video, we're going to talk about the interim budget 2019 and the major parameters that were a part of this budget, what really worked and what were the major provisions that came out. To be fair, broadly, this wasn't a very big kind of an event. Interim budgets never are, because the main budget in an election year happens after the election is conducted and the new government is formed. So it probably was going to be anyway not a very news intensive budget in that sense, something we had anticipated. Usually all budgets are a toss up between populism and fiscal prudence, and while there was a wide expectation that there could be a lot of populism, it was reasonable in terms of there was a reasonable combination of both populism and fiscal prudence. The government majorly focused on the farm segment and lower income segments, but they did not really touch income taxes and corporate taxes too much. They gave some benefit to certain segments, but not to a very wide variety of the segments in the taxation space. So that was a broad contour. We had anticipated that the major focus would be on some of the key sectors around the rural outlay or farm sector, affordable housing, a little bit on taxes and a bit on infrastructure. We did anticipate that infra may not see too much of an outlay. While the government did increase the outlay from what was suggested last year, there wasn't a very big bang announcement around infrastructure this year. The major announcement did happen around the farmer support income support scheme, and that is something we're going to look at discussing as we go along. Most of the rural schemes did see reasonable outlay as well, which again we had anticipated getting into the elections. There was a focus on affordable housing. There were certain housing sector reforms that were kind of carried out, although we will see that in terms of when we look at, let's say, an equity market perspective, not many firms may benefit from what was really extended. Taxation, largely stable data points. No major changes were expected in corporate rates or indirect taxes. There was an expectation on income tax relief, which the government has interestingly kind of narrowed down to a certain segment of the income taxpayers and not to everyone. So that was something that was bordering a little bit more on the fiscal prudence. So we'll take a look at that as well. Let's look at estimates first. So what you see in the first column is FY19 budget estimates. What you see in the second column is the revised estimates for where we are currently and what is expected in financial year 2019. And the third column is this particular budget estimates that were given in the interim budget. So there weren't too many major changes between the budget estimates and the revised estimates. The government has said that they should be able to manage most of the stuff as was happening and as was projected. So even the tax revenue is likely to be kind of close to what was expected. Non-tax revenue would be expected to be close to what was expected. Fiscal deficit is likely to be almost what it was expected. No major changes in any of the numbers that you see. The only interesting data point was that capital expenditure actually went up. The government suggested that capital expenditure would go up versus what initial expectations of broad markets was that it would go down. So that's where we were. Now we'll turn our focus into what were the estimates for the current forthcoming budget and how much of a growth the government is anticipating out of that. So when we compare the second and third column, we'll see the government expects a healthy jump in the overall tax revenue, bordering around 14%. Bulk of this is going to come from a direct tax revenue growth, which is expected at 15%. Indirect taxes are also expected to grow at about 12 to 13%. Net to the center, the tax revenue would be about 17 lakh crore. 17 lakh crore as a percentage, the 25 lakh crore as a percentage of GDP would be approximately close to about 12%. So the government is maintaining its target of 12% tax to GDP ratio. Possible to achieve, though there are some areas that we might want to kind of take a look at as we go along. The non-tax revenue, which is dividends from PSU entities, dividends from RBI, etc., is also expected to register a growth of 11%. The government does suggest that there is going to be an increase in the RBI dividend as well. Disinvestment target, the government said they should be able to achieve for this particular year, and they have given a slightly higher target for next year at 90,000 crore. Added together, if I add the tax revenue net to center, that's 1, non-tax revenue 3, and 4, that gives me my total receipts. without considering the debt portion of it. The expenditure budget, on the other hand, shows an approximately a 14% increase in the revenue expenditure, which was on the cards, given that most of the scheme outlay basically happens here, and given that the government would kind of put a little bit of focus on populism in this particular budget, there was an expectation of increase there, which has played out. Interest payments of Government of India are expected to rise 13%. That's in line with basically, what's happening with the markets, the amount that you had borrowed extra over the last year. That would play out in terms of data points, and major subsidies are expected to rise 11%. So the government continues to give a better outlay on subsidies. Again, kind of expected. Probably part of it would happen any which ways getting into the elections. Again, interestingly, the government has given a reasonably, good outlay on capital expenditure in terms of growth. Not many people were expecting that the government would continue to kind of focus on capital expenditure, and probably if they had to increase something, they might increase it more on the revenue side. But they did give a decent outlay there as well. The government continues to kind of say that the fiscal deficit target, which is going to be about 7 lakh crore, is going to be about 3.4% of the GDP. So there we are saying that approximately the GDP growth, nominal GDP growth expected is about 11%, give or take a few. So we are probably expecting a 7.5% kind of real GDP growth, and probably a 3 to 3.5% kind of an inflation number. And based on that, we are going to see that the fiscal deficit number would probably be at a 3.4% of the GDP. So far so good in terms of the broad fiscal prudence. It remains to be seen that what happens to numbers that basically overshoot these targets, and whether or not the government continues to kind of focus on extra budgetary resources for this outlay. So no major changes that you would kind of think of as extraordinary. It wasn't expected to be extraordinary in that sense, so it is kind of in line with what was broadly expected. Now, some more data points in terms of the budget size. This is a graph from the India budget website itself. So where does the money come from? So the receipt is on the left side, and 27.84 lakh crore is the total receipt as well as expenditure of government. So it comes from primarily the tax revenue, which is 25 lakh crore, out of which 8.45 goes to states. Net tax receipts 17 lakh crore, non-tax revenue combines and gives some data points. Capital receipts, non-debt capital receipts is all disinvestment and the data points around loan recovery. And then you have debt receipts, which is nothing but this number is the same as the fiscal deficit number. So that's what we are combining in terms of the total receipts that come in. The total expenditure on the other hand is going to go towards a variety of things. So there are some scheme expenditures. Here the government has not given an exact breakup into revenue and capital, but they've kept kind of it clear as schemes that the government has some centrally supported schemes. So central sector schemes and centrally sponsored schemes are about 12 lakh crore, and transfers, establishment and other expenditures come here. So that kind of puts a pension scheme, establishment expenditure, which is all the salaries, etc., would come here. Other central expenditure would come here. And there would be some other data points which would come, which would include things like interest payments also coming in here. The subsidies portions is mentioned here. Three major subsidies: petroleum, food and fertilizer. The largest is food, followed by fertilizer, followed by petroleum. So food subsidy continues to see a focus from the government. Nearly 1.84 lakh crore. 1.84 lakh crore is what has been given towards food subsidy, right? If you look at the estimates on the direct taxes front, the estimates for the budget were 6,21,000 crore for corporate tax. That seems to be overachieved this year. So that seems to be shooting up this year. So that's a good indication that if you actually compare the growth from here to here, that seems to be a reasonable growth, which does tell us that corporate health probably is not as bad as what some sections of, let's say, media might believe. Income tax growth rate would probably kind of match what was the initial estimate. So that's again a healthy sign. The government does believe that they would be able to get some slightly higher than expected numbers on the direct taxes. They had estimated 11.5 lakh crore. They're probably going to end with 12 lakh crore. That's their revised estimate. We need to see if that ends up during the year. If you look at the budget estimates, they're saying 13% growth on corporate revenue, corporate tax, and 17% growth on income tax. Now, this is something that we'll have to see whether is achievable in the coming year, purely on account of what happens with markets and whether or not this works. There is a fair likelihood that we would be there or thereabouts. Even if we are not able to achieve it, we'll be probably slightly short of it, but this looks like a broadly achievable or close to achievable target, though the corporate revival does need to happen, right? So if corporate sector does not revive as fast as what is expected, then this number might have a little bit of a challenge as it comes in. So we'll see where that goes. If you look at major schemes, the government has some schemes which are called as core of the core schemes, and then there are the other core schemes which are there. So core of the core schemes would include, most famously the MNREGA, which comes here. Then there are development of scheduled castes, scheduled tribes, minorities, other vulnerable groups, and national social assistance program. The outlay on each of these is not very large, but you would see that there are some variances between what was estimated in the budget and what is expected in the revised estimate now. So we did estimate last year that this 55,000 crore looks low, so that is suitably been increased to 61,000 crore this year. This year's estimate is 60,000 crore, and the government has said that it will be increased if required. So that's possibly going to happen. Then umbrella scheme for development of scheduled castes essentially again saw a big upside in terms of what was given as an outlay. Again, the number has been given with respect to last year's number, but you would probably see an upside here as well in some of the schemes that are centrally supported. And you would probably see more allocations happening to this as you go along during the year. The other core schemes that you see include primarily your food subsidy, etc. So you see the food subsidy under the Food Security Act. That amount is expected to be about 1.51 lakh crore. And there's another component of food subsidy, which is, on decentralized procurement of food grains. That is 33,000 crore. You add the both of them together, that is 1,84,000 crore, which is what we had seen on the previous slide. So these are the top 21 odd schemes in terms of government expenditure or government schemes that are there. So let's check some of the major movements in this. So one of the new entries is this income support scheme, which is happening towards farmers. And we'll look at this in a little bit more detail as we go along, but 75,000 crore is estimated to be a part of this over the next year. The government has suggested that they will actually start it this year itself, with 20,000 crore being allocated in the current financial year itself, and then followed by 75,000 crore. We will look at the math of 75,000 crore in a minute. If you look at some of the major changes other than that, direct benefit transfer outlay has increased by 79%. So that's a pretty healthy increase. Pradhan Mantri Gram Sadak Yojana is an increase of 23%. Now that's as against the revised estimate. Honestly, last year's budget estimate was also 19,000 crore. They ended up only allocating 15,500. So from there, it looks like a big jump, but otherwise it's the same number that was estimated last year as well. The estimate on short-term credit to farmers, so interest subvention or subsidy, is expected to rise again. So again, farm sector is going to see a benefit out of that. You look at some of the other segments such as, urea subsidy. You look at road works, that is probably seeing an increase. National Education Mission is likely to see an increase, which is a good thing. Then there are some other, sort of suspense accounts which are there where there is an increase that is expected. You do look at metro projects also, interestingly seeing an increase, although this number is pretty small when you compare to the overall, budget size of India. This is a small number, but nevertheless a healthy sign that, infra in terms of some of these segments does see a healthy outlay. It may not be a very big increase, but it's a healthy outlay in a lot of these segments. Interestingly, in Pradhan Mantri Awas Yojana, they are showing a decline in terms of the outlay, but there was a substantial number that was anyway there, so there are probably being plugging some of the loopholes, and maybe some part of this direct benefit transfer is also around some of these schemes, but is going through a DBT kind of a scenario. So all in all, mostly a rural segment kind of a budget, but there is some healthy signs in terms of what's happening on the infra space as well. If you look at some of the core schemes that the government has said, it seems that we will overshoot some of the outlay on the rural segment. It is unlikely that we will meet that. So let's arrive at that income scheme. We'll look at some of the major provisions of the budget. So something around Pradhan Mantri Kisan Samman Nidhi Yojana was announced, and this was basically the farmer support package that we were thinking might come in. Our anticipation was something like 6,000 rupees or 5,000 rupees per acre per crop kind of a thing. The government did come up with an area of about 2 hectares, which is slightly less than 5 acres. So they did talk about 5 acres, and that kind of has 86% of total farmers of India in that land. But they've kept it at 6,000 per year, not on a per crop basis. They have increased it, the estimated amount slightly, but kept it at a per year basis. Now, this is going to be a direct transfer to bank accounts of beneficiary farmers in 3 equal installments of rupees 2,000 each. One particular installment will also happen for this particular year itself. So annual expenditure of 75,000 crore. It comes in terms of an understanding of roughly about close to 12 crore farmers. So they say around 12 crore small and marginal farmers will benefit, and this 12 crore multiplied by 6,000 is about 72,000 crore, which is the overall expenditure that we see here that comes. This on a total GDP size of roughly about 2 crore. Remember, we said that 20,000 crore is roughly about 10 basis points of the GDP, or 0.1% of GDP. So we are looking at about 3.5 or 35 basis points or 0.35% of the GDP going towards this specific scheme. And we do need to see how the government is able to kind of manage it, because they have provided it within the budget expenditure, and the expenditure has included this part. So let's see how they are able to kind of garner this extra revenue in order to keep fiscal deficit in control. Nevertheless, a decent scheme. Also, the good part about some of these schemes that are direct benefit transfer is that a direct benefit or cash benefit transfer is a sort of a last mile help, rather than trying to kind of give a subsidy where, for example, if you give a lot of food subsidy, that gets lost in the channels in between. Not necessarily the correct beneficiary of food subsidy is the person who needs that food subsidy. But direct benefit transfer definitely goes to the last mile. And so to that extent, the leakages in the system kind of get evaded. It's always a good idea to use some sort of a direct benefit transfer instead of even things like, loan waivers. So rather than giving a loan waiver altogether, it's probably better to give a direct benefit transfer so that, the credit profile doesn't change for people. They don't go and generally default even when they can pay. In addition to this, there was a reasonably big announcement on the unorganized segment as well. So all workers in the unorganized sector, the government has said that people with income up to 15,000 can enroll for this scheme, which is Pradhan Mantri Shram Yogi Mandhan. And here there is sort of a monthly pension of 3,000 from the age of 60 years. And they've said that someone who joins at the age of 29 years has to contribute 100 rupees per month till the age of 60 years, and the government will make an equal matching contribution. Someone who's joining at 18 years just has to make 55 per month, and the government will deposit an equal in the pension account of worker. This year, only about 500 crore has been allocated to this. Additional funds will be provided as needed. So I think the worker will have to go and register themselves under this particular scheme, and only then they will be eligible for this pension scheme which is there. So that's another thing that happened. In terms of taxation provisions, the government said that individual taxpayers having taxable annual income up to 5 lakhs will get a full tax rebate. Note the key usage of the word. rebate. It is not a slab movement for everyone. It is only that if you have a taxable income of 5 lakhs, then you get a rebate. So up to 5 lakhs, typically the tax that was applicable was 5% of the total income between 2.5 to 5. So that amounted to 12,500. Earlier, the government was already giving a rebate of about 2,500. They have increased this to 12,500. So net net, what it means is that if your income is less than taxable income, remember, and so taxable income is after all the adjustments you made, is less than 5 lakhs, then you get the benefit. If your income is more than 5 lakhs, then there is no change. You continue to come under the same slab. So if your income is 5 lakh 1,000 or 5 lakh 2,000, you still pay the entire 12,500 to the government. So I think between 5 lakh and 5 lakh 15,000 is where there is a sort of a odd scenario where if someone's income is 4.99 versus someone's taxable income is 5.01, there is an outlay of 12,500 there. But nevertheless, there is some benefit for the lower segment of the income tax payment mechanism. What it does do is, interestingly, it encourages people to kind of declare an income up to 5 lakh and increases the tax base or taxpayer base. What that does is whenever the income increases in the subsequent couple of years, this entire segment would also fall under the bracket of taxpayers. There is also a standard deduction that was 40,000, so that's been increased to 50,000. That's happened for everyone who's salaried. So anyone who's salaried gets an extra 10,000 rupees benefit on the total taxation. So that would work to anywhere between, your income going down by 10%. So whichever slab people are in, 5, 20 or 30, they will get a benefit of 20 or 30% of this amount essentially. So that's on the personal income taxation side. On the real estate sector, there were certain provisions. So currently, if someone has more than one self-occupied house, let's say I have 2 houses and none of them are on rent. I stay in one of them and someone else stays in another, or there's just one which is lying vacant. On the second house, there was a notional rent taken and an income tax was levied on that. So that has been done away. So that exemption has gone away. So if someone has 2 houses, that would be exempt from any kind of notional rent expense. If it is let out, then you obviously have to pay an income tax on that. Then there used to be a capital gain section 54, which said that if you sell a house and you get a sort of a capital gain out of it, you could reinvest the proceeds into one house and get a tax rebate on that amount. So I sell a house and I immediately buy another one. So to that extent of that amount, I will save the capital gain tax that would happen. Now they have said that rather than one, they will take it to 2 residential houses for a taxpayer having capital gains up to 2 crore. So that's beneficial that, if someone sells a big property and then, tries to go and buy another one which is large enough, they could rather buy 2 of the properties which are there. Although not sure how many people would actually be looking at this in terms of an investment idea. So I don't really know how much of an impact on urban real estate this is going to directly have. For the purpose of affordable housing, they had some section where income tax benefits were given. So that's been extended for 1 more year for housing projects approved till 2020. And if a developer had not sold inventory, there was an exemption for 1 year. But after that, if you have not sold the inventory, the developer has to pay income tax on notional rent, right? Now that exemption has been moved from 1 year to 2 year. From the end of the year in which the project is completed. So earlier, if the project was completed in 2018, so 2019 is still where the rebate was. But if then you have not sold a house, that house would be considered to be on rent, and notional rent will be considered as taxable income for the developer, the real estate company. Now that has been extended to 2 years. So that should give some impetus to the developers. But once again, I don't know whether it will be having significant impact on urban real estate as such, because the price itself is probably a little bit odd in lots of localities. Then there's a TDS threshold, not a very major announcement, but basically if you had a fixed deposit in a bank and your interest on that was more than 10,000, there was a TDS deduction that used to happen. That threshold has been increased to 40,000. So to that extent, that's a beneficial thing. Similarly, TDS threshold for tax payment on rent has been increased from 180 to 240. Remember, this is not a tax reduction. This is just a TDS threshold. So earlier you were paying TDS at a 10,000 interest. Now you will not pay TDS up to the interest being 40,000. So to that extent, this is a slight benefit that that works out, right? A couple of quick other data points. Total debt position of Government of India is about 90 lakh crore, and it's expected to go to close to 97 lakh crore next year. This is because you will borrow more to fund your fiscal deficit. Recall that India's GDP is probably 2 crore, right? And we have 97 lakh crore here. So effectively what we are saying is that the GOI, debt to GDP ratio, is 97 divided by 200, so that's approximately close to about 50%. 48 to 49% is what we are seeing. That's a fairly healthy number. This does not include state government liabilities. The other interesting part is external loans out of total loans. So this is basically foreign currency. Let's, for simplicity purpose, write dollar here. This is a dollar loan that is there. That is only about 2% or 3% of the total loan amount that is there. So that is where bulk of the trouble happens. Most of the debt in government books in India is coming from internal sources. There the government usually has no reason to default because you can print rupees and give it back. It is only external debt which is a problem, which is honestly very low for India. So from a debt perspective, India is in a fairly comfortable scenario, and consequently, even if we miss the fiscal deficit a little bit here or there, it doesn't really impact things dramatically too much. So honestly, that 3.4, 3.5% is a good number to achieve at. But even if it goes up 30, 40 basis points, it's not like that's a significant end of the road for the government. Reaction on the markets. Equity markets reaction was fairly neutral. There was no real movement that happened other than a little bit of volatility, which is usually the case on any budget day. No major reaction other than that. Debt market reaction was interesting. So you had seen post the change in the RBI governor, the yields on the 10-year bond had declined. They had been kind of increasing a little bit heading into the budget, but just before the budget there was a decline in the yields to 7.34 kind of numbers, and then suddenly on the budget day there was an increase. Now these are estimated numbers, you could have a slight difference, but there was an increase that happened in the 10-year yield. Now why would that happen? That's probably because the bond market anticipates that all these income support schemes will result in higher disposable income, right? So higher income for people, which they will spend, and consequently there could be an inflationary play that could come out. So there was a section of the markets which now says that it's possible that the RBI may not cut rates immediately. They might wait a couple of quarters before deciding whether they will go ahead and cut rates, or even if they cut rates, they may not be as aggressive in cutting rates, purely because this extra money that goes into the hands of people, especially getting into the elections, is probably going to be a little bit inflationary in the nature. So that's one of the questions that that was kind of coming out of this particular budget in terms of the debt market. Other than that, no major impact on equity markets, unlikely to really change the trend because honestly there weren't too many sector moving announcements. Interim budgets are not known to have substantial announcements, so to that extent we were fair enough in terms of a very muted reaction overall. To summarize, I think the government was able to maintain a reasonable fiscal prudence while targeting specific focus segments like farmers and unorganized sector. It has likely overestimated incomes. We might see a struggle to achieve that tax revenue target, and possibly underestimated fiscal deficit also because it might have underestimated some of the expenditure. Farmer support package was widely expected, and that was the main highlight. Unlikely to have a major impact on equity markets in the sense that markets will continue to do what they were doing. It is unlikely to have a very major impact in terms of changing the course or direction or the underlying sentiment in the stock markets. Bond markets reacted since, as we said, the measures may have an inflationary impact in terms of increasing disposable income for people, and thus might result in some sort of a delay in terms of RBI cutting rates, which otherwise was being widely expected in the subsequent monetary policy meets. That, in a nutshell, was the budget. Not a very heavy duty budget. It was kind of more a statement of what the government has achieved in the last few years and what they're likely to achieve over the next few years. So I think kind of in line with the norm on interim budgets, no major earth-shattering announcements, so unlikely to have too much of an impact on major financial markets as we go along. So that's broadly it in terms of what our understanding of this particular budget is.